Employee benefits are considered non-cash or non-wage compensation that's provided to employees. These benefits are provided in addition to normal wages and salaries. Most benefits are voluntary, meaning the employee can choose which benefits to take from the offering. Other benefits are mandatory. These are based on laws that outline benefits to provide economic security for employees and their dependents, such as Medicare withholdings. The type of benefit offerings will vary based upon the results of a needs assessment and the benefit philosophy. This is where the organization continues how to make decisions about specific details related to benefits coverage. It outlines how a business chooses and provides benefits to employees. Social Security benefits and Medicare are the most typical form of mandated benefits. Social Security is designed to provide retirement income for American workers who pay into the system. It's funded through FICA taxes, which stands for the Federal Insurance Contributions Act. Earnings are taxed, and a portion of those taxes are paid by the employer, and a portion is paid by the employee. Social Security works by pooling mandatory contributions from workers in a large pot and then paying out benefits to those who are eligible for them upon retirement or disability. When you work, you pay into the system by having a portion of your earnings taxed and earmarked for a future Social Security benefit. Medicare works much like Social Security and provides health insurance coverage for Americans aged 65 or older, or those with certain disabilities or medical conditions. The Medicare tax helps fund the Hospital Insurance Trust Fund, which is one of the 2 trust funds that pay Medicare claims. Unemployment compensation, also known as unemployment insurance, also exists for the event when an employee involuntarily loses their job. Unemployment compensation provides partial income replacement for a short time. Both employees and their employers contribute to unemployment compensation insurance, which is administered by the government on both a state and federal level. Workers' compensation is also required by federal law, however, it is administered by individual states. Workers' compensation is a form of insurance that provides wage replacement and medical benefits to employees injured in the course of their employment. It typically offers medical care, wage payments, and rehabilitation and survivor payments to employees injured on the job. While not mandated by any specific labor law, once an employer chooses to offer certain financial benefits, they tend to be regulated. Examples include life insurance, memberships, and financial counseling. Personal and family-style benefits may either be voluntary or involuntary. Benefits under this designation could be employee assistance programs like life coaching, legal support, and counseling, as well as the extension of such benefits to domestic partners. Medical benefits cover items such as health, pharmacy, dental, vision, and other similar plans. The health plan is likely the most meaningful to the employee and their family. Medical benefits are commonly in the form of a preferred provider organization, known as a PPO, a health maintenance organization, known as an HMO, or an exclusive provider organization, known as an EPO. A preferred provider organization, or PPO, typically offers a large network of participating providers, so the employee has a choice of many doctors, hospitals, and other healthcare professionals and facilities to choose from. Plan participants may also choose to see providers from outside the plan's network, but may pay more out of pocket as coverage may only apply at a reduced rate. A health maintenance organization, or HMO, gives the employee a local network of participating doctors, hospitals, and other healthcare professionals and facilities that the participant is required to choose from. These types of health insurance plans also require the participant to choose a primary care provider, or PCP, from the network. The PCP is the home base for medical care. They get to know the patient and coordinate all the medical care. Seeing an in-network specialist would require a referral. The costs for an HMO plan are typically lower than any other type of health plan as long as we stay in network. Exclusive provider organizations, also known as EPOs, offer participants a network of participating advisors to choose from. Most EPO plans do not include any coverage for out-of-network care except in the case of an emergency. This means that if the provider or facility is outside the plan's network, the patient will likely have to pay the full cost of services. As PCP plans may vary, you may or may not be required to choose a primary care provider. a specialist can be seen if within the network without needing a referral from the PCP. Regardless of the type of plan, it may be necessary to perform a utilization review at a regular frequency. This is a process undertaken by employers and insurers to monitor effective use of healthcare by requiring third-party evaluation for the need of medical treatment. This review could provide data on benefit design trends, utilization patterns, and cost. Time off is also essential to a quality work-life balance and is often a key consideration to a new employee. Some time off may be legally required, such as for a military leave, while most time off is not required and would comprise of vacation time, sick time, or other paid time off option. Since paid time off is not a guaranteed right for the majority of workers in the United States, it instead relies on individual businesses to decide their own policies. The Family and Medical Leave Act, commonly known as FMLA, provides certain employees with up to 12 weeks of unpaid, job-protected leave per year. It also requires that group health benefits be maintained during the time of the leave. While this is not paid time, it protects the job while the employee is not working. Employers may choose to offer additional benefits, such as long-term or short-term disability programs, which may provide pay continuation for such events. To be eligible for FMLA, an employee must meet a few conditions, such as have worked for the employer for at least 12 months, have worked at least 1,250 hours over the past 12 months, and work at a location with at least 50 employees employed by the employer within a 75-mile radius. As the United States has no federal law requiring employers to provide paid vacation, it's also a benefit that remains one of the most common. There are some states which have enacted laws requiring employers to provide paid leave that employees can use for any purpose, including vacation. There are also some states that require employers to pay out any accrued, unused vacation at the end of a year or at separation. Some organizations will decide to implement a paid time off policy, otherwise known as PTO. Under a paid time off policy, employees can use the time off for any purpose they wish. The benefit of a PTO policy is providing employees with flexibility to take time off for any reason without having to give their manager too much information. It may also be helpful to HR as there's no need to separate the time off into various reasons, as it's all in the same bank of time. Some organizations will allocate a specific amount of PTO for their employees, and some may offer an unlimited PTO program. Other types of time off may fall under PTO, however, there may be specific types of time off that can only be used for an appropriate reason. Vacation leave is the most commonly offered leave benefit. It is generally used for time away from work for rest, relaxation, travel, handling personal matters, or other planned reasons. When an employee uses a paid vacation day, they don't have to work that day, but they will receive the same pay as if they worked. Vacation leave is typically scheduled in advance, although some employers allow employees to use vacation time for unexpected absences. Sick leave allows the employee to receive the same wages as if they worked. It's important to remember that paid sick leave is different than family leave laws. This type of time off can be used for unplanned or unforeseeable events and is typically used for absences due to an employee's own illness or injury, or to care for the sickness or safety of an employee's family member. While no federal rules exist governing sick time, some employers are required by state law, city ordinance, or federal contract to grant paid sick leave to employees and to allow employees to use sick leave for other relatives such as parents, spouses, or registered domestic partners. Personal leave is a type of time off that can be used for any reason, planned or unplanned, and typically supplements vacation and sick leave for short-term absences. As federal law does not require any payment for time not worked, it would be up to the employer to establish a personal leave policy and determine if the time is paid, unpaid, or falls under any other scenario. Retirement plans are also a key employee benefit. Retirement plans may be categorized as either qualified or non-qualified. The primary difference between the two types is whether the contributions are tax deductible or not. Both plans allow for tax-deferred growth on earnings attributable to plan contributions. For a plan to be considered a qualified plan, the Internal Revenue Service determines the plan eligible to receive a certain tax benefit. If the plan meets specific IRS requirements, it allows the assets in the plan to grow without taxes being paid until the money is withdrawn, typically at retirement. Examples of qualified retirement plans are a 401k, 403b, or profit-sharing plan. These plans only allow certain types of investments, such as mutual funds and real estate. A plan must meet some criteria in order to be considered qualified, including minimum participation requirements, or employees being required to meet minimum age and service requirements. The plan documentation must accurately reflect the actual benefits given to the participants. The plan must meet non-discrimination requirements, and any employer matching must be the same for all employees regardless of compensation level. Sponsors must submit tax forms and adhere to reporting and disclosure requirements and maintain account balance statements. The plans will also have limits on minimum distribution, minimum vesting, defined benefit plan limits, defined contribution limits, as well as maximum annual compensation. Qualified plans come in two main types, which are a defined benefit plan and a defined contribution plan. Under defined contribution plans, the amount employees receive in retirement depends on how they manage their investments within the plan. As the name suggests, the amount contributed by the employer is defined. The participant then invests the funds as they wish. There's also an option to establish a defined benefit plan. This type of retirement plan is funded by contributions from employers or employees, or possibly both. Any contribution made by the employer may offer a tax benefit by reducing an employee's taxable income by the contribution amounts. A defined benefit plan guarantees a specific amount of money that employees can expect at a future time. This could be a lump sum amount or monthly income in retirement. Because the focus is on the final amount, a defined benefit plan places the future financial responsibilities on the employer. A common example of a defined benefit plan would be a pension that provides a specific or particular amount of a benefit at a particular date. Profit-sharing plans are a popular form of defined contribution plans. These plans do not require a fixed contribution formula and allow contributions to be skipped in years of low profits. Their flexibility and ease of administration has made them a popular retirement plan option for employers. 401k plans, also known as thrift plans, are the most popular form of retirement plan today. This type of defined contribution plan allows the employee to elect to contribute a percentage of salary to their retirement account. Contributions are excluded from the employee's gross income and accumulate tax deferred. Employers are permitted to make matching contributions up to a specified percentage of the employee's contributions. 403b plans work much like 401k plans and are tax-sheltered annuities available only to employees of public educational institutions, tax-exempt organizations, and religious organizations. Employee stock ownership plans, also known as ESOP plans, are used to facilitate employee stock ownership. In this plan, companies may allocate their employees with stock which may be at no upfront cost to the employee, or enabling the employee to purchase stock which may be at a discount, or granting employees stock option. A simplified employee pension, or SEP, is a qualified plan that offers ease of administration to small business owners. Employees open IRAs and the employer makes contributions on their behalf. Employee contribution may also be made into the same IRA accounts. The Savings Incentive Match Plan for employees, also known as a SIMPLE plan, is a tax-deferred retirement account that enables small employers to contribute to their employees and their own retirement savings. This plan is only available to employers who do not offer other retirement plans and have fewer than 100 employees. Non-qualified retirement plans do not adhere to the Employee Retirement Income Security Act or ERISA guidelines. Because they do not meet the requirements to become qualified, the contributions made to these types of plans are usually non-deductible to the employer and are also taxable to the employee. It's important to note that non-qualified plans are considered to be assets of the employer and can be seized by creditors of the company. Additionally, if the employee leaves the organization, they will likely lose the benefits of the non-qualified plan. Due to these factors, non-qualified plans are generally used to provide highly paid executives with an additional retirement savings option. Deferred compensation plans are plans that allow an employee to defer accepting part of their compensation until a specified future date. These plans are contractual agreements between a company and an employee in which the employee agrees to defer receipt of current income in favor of payout at retirement. This is generally used for highly paid executives, as these allow for part of the compensation to be placed in a separate fund that earns a specific rate of return until distribution. Because this is not a qualified plan, the employee will pay Social Security and Medicare taxes on any of the deferred income. However, they will not need to pay income tax on the deferred compensation until the funds are received. This can be a benefit for an executive who expects to be in a lower tax bracket at a later date, deferring compensation until then. These plans are not available to persons who are affiliated with the company as a board member only because they are not considered employees for retirement planning purposes. Split dollar life insurance plans allow for a life insurance plan to be paid by the employer and employee. In this plan, an employer and employee execute a written agreement that outlines how they will share the premium cost, cash value, and death benefit of a permanent life insurance policy. Group carve-out plans are specialized life insurance plans that employers may offer to a select group of high-value employees, such as executives. This plan is designed to go above and beyond other insurance options offered. Group carve-out plans are typically used by the organization as a way to retain their key employees. The Employee Retirement Income Security Act of 1974, also known as ERISA, was established to prevent abuse and misuse of pension funds. ERISA guidelines apply to private sector retirement plans and certain union plans. ERISA does not cover public plans like those for government workers. ERISA includes some very specific provisions such as participation, which identifies eligibility rules for employees. This states that all employees must be covered if they are 21 years or older and have performed at least 1 year of full-time service, which ERISA defines as 1,000 hours. Funding requires that funds contributed to the plan be segregated from other corporate assets. Plan trustees have responsibility to administer and invest the assets prudently and in the best interest of all participants. IRS contribution limits must also be observed. Vesting entitles employees to their entire retirement benefit within a certain number of years of service, even if they leave the company. Communication is required, as the plan document must be in writing and employees be given annual statements of account and updates of plan benefits. The plan must be clear of discrimination, meaning all eligible employees must be impartially treated through a uniformly applied formula. And finally, a beneficiary requirement. Beneficiaries must be named to receive an employee's benefit at the time of their death.